Yesterday we started with this topic called as international aspects. Under that, we looked into what are international markets. So the the instruments, financial instruments which are traded in the international market, depending on the time period, are categorized as euro currencies for short-term period, euro credit for medium term, and then euro bonds for long term. But the term euro itself indicates that it the financial instrument is in any other currency other than the domestic currency. So the term euro means securities denominated in a currency other than that of the investor. So then we have looked into what are foreign exchange markets. See, when people trade in foreign currencies, so in that case, the transactions take place in foreign exchange markets. So the purchase and sale of foreign exchange with that, what are the attributes or what are the characteristics of that? That helps in finance international trade. It is as a part of financial asset management to benefit from movements in the exchange markets to manage exchange rate risk. So if the transaction is settled immediately, we call that to be a spot transaction. The settlement is immediate, but in case of the transaction, if it is not fulfilled immediately, if it has to be fulfilled at a later period of time, they enter into derivative agreement like a forward rate agreement or futures. So they enter into the agreement to be completed at on a future date. So at a pre-decided price. So forward transactions involve entering into a transaction now for delivery on a future date, effectively fixing the price of the currency in advance. So I have also yesterday briefly explained about what are derivatives. So the agreement will be completed on a future date. At a predefined price. Okay. Simply, we have looked into what is the how do we define whether the currency of a particular country is a strong or weak? When does it strengthen? When does it weaken? Is also we've looked into. So there was an example. There's an example here on the screen. See, if it is $1 is worth in terms of yen, it is 108.21. So to acquire $1, the in terms of Japanese currency, 108.21 yens have to be spent. Okay, but let's say if the value of yen has, if the currency values have reduced, that is, if yen, the number of yens that are needed to purchase $1, if it is 105, then we call that yen has strengthened. So which means that less amount of yens have to be spent to acquire the same dollar. The other way around, we call it to be as if the number of yens have increased, let's say 110 or so, then we call that the yen currency has weakened. So that is how that concept has to be remembered. After that, we have also looked into what are the different types of foreign exchange risk. There are 3 types of foreign exchange risk because of economic activity, any economic risk. Consistently, if we see that there are fluctuations in the exchange rates, then that will have an impact on the imports and exports. So if the local currency has strengthened, so if the strengthening of local currency, so at that time, whenever they export, they would receive less amount of domestic currency. If the local currency has weakened, then in that case, that will have an impact on the imports. So when they import foreign material from foreign countries, then in that case, they will have to spend more amount of domestic currency to settle the import. So that will have an impact on the import business and export business, because fluctuations are seen for a long period of time, which we call it as economic risk. Then transaction risk, the time period from the time they agree to take up a transaction and the day when they actually pay the amount. So any time period between these two, if there is any fluctuation, if that fluctuation in foreign exchange affects the business, we call that to be as transaction risk. Translation risk is if there are investment into assets made by any company on the day when the financial reports have to be disclosed, the assets which are there in the foreign countries, because all the transactions when they have to be consolidated. So at that time, the investments into foreign countries which are made, the investments that are made in foreign countries, so the asset value has to be then translated into the domestic currency. At that time, see, on translation, because of fluctuation in foreign exchange, the value of assets may seem to be low. So any kind of a risk which exists on account of this, we call that to be as translation risk. So economic risk, transaction risk, and translation risk. Let's continue further, and then we'll finish off this particular chapter today, including the MCQs also. Mitigating foreign exchange. Mitigation is putting an effort to reduce the risk that arises because of a transaction. See, there is a risk which is present. So risk can be because of, now here in this case, we are very specifically looking at the fluctuation in the foreign exchange rates. So if at all, if there are fluctuations and that has an impact, so the risk is downward risk. If there is a negative impact on the business, then that is anticipated, that is foreseen that there would be a risk present because of fluctuations in exchange rate. Then certain mitigation or certain activities involving mitigation or can be taken up. So mitigation, in the real sense, it means the meaning of mitigation says that if some activity taken up to reduce the amount of risk that is present. So mitigating foreign exchange transaction risk. The transaction risk is, what is transaction risk? Just now we've looked into the time period which is required from the day when the order is placed, or the time period between an order being agreed and the payment received. So if there is a time period, time lag, definitely there would be a time lag, because the day when the order is placed, most of the time we do not see that the goods are received. One second. If see, there would be a time gap between the order placed and the payment received. So that time lag, during that time period, if there is any fluctuation in the foreign exchange, then that is referred to as transaction risk. Okay, the transaction is set to be completed. So then on completion, the payment is received, but the payment which is made on that date, if it has a lesser value because of fluctuation in the foreign exchange rates, any risk that arises is called as transaction risk. So how to minimize the risk on account of transaction risk? So here there are certain options. There are derivatives which are discussed here. See, let's say that if there is an order placed on January 1, so the order is placed on January 1, but because of the nature of the order and the order is delivered, then the material is received and it is checked for that, and the terms and conditions, let's say that the payment is made on February 1. So there is a time period of 1 month. See, the day when the order is placed, so the rate could be something else. The day when the payment is finally settled, the rate could be something else. So there is a possibility of a fluctuation in the foreign exchange. So now, if at all, if there is a fluctuation that could affect them negatively, that could also affect them positively. So there is a possibility of negative impact being there. Now, how to minimize or minimize that risk because of fluctuation? So that concept is called as mitigation of foreign exchange risk, or very specifically foreign exchange transaction risk. So they know that when is the date the payment would be received. So things can be decided and they can enter into a derivative agreement. The first one is called as, see, I told you there are 4 types of derivatives: forwards, first one, futures, then options, then we have swaps. So 3 things are discussed here. First one is forward exchange contracts. So what does it have? I mean, how does it work out? What happens in that? So they, on the day when the order is placed, they can also enter into a forward contract stating that enable the purchase and sale of currencies at a fixed exchange rate for a specified time period. So now, if the settlement is on a future date, they can decide on what is the rate at which they would be settling things. Okay. Here, now the purchase and sale is related to foreign currencies. So people trade in foreign currencies. They buy foreign currencies and sell foreign currencies, and they get benefited on account of the variation of the fluctuation in the foreign exchange. So now, if at all, if there is a transaction involving foreign exchange, okay, at that time, see, the day when they decide on transacting in foreign currencies, they can also decide the rate at which they would be fulfilling the contract. Enable the purchase and sale of currencies at a fixed exchange rate for a specified time period. So let's say that if they are considering a time period of 1 month, see, on the day when the purchase and sale would happen, on that date, at what rate, at what, see, they would be fulfilling that contract also can be decided. See, once the rate is decided, that will be binding upon both the parties, irrespective of what is the rate that is prevailing in the market. In the exchange market, there might be, the rate might be something so very different also. Still, because they have agreed upon, they have entered into a contract to fulfill the contract at a fixed specified rate. Therefore, they are under an obligation to fulfill that at that fixed rate. Now that does not get affected because of the fluctuations in the exchange rate market. Then that is forward exchange rate. They can also enter into future contracts. So future contracts are similar to forwards. So similar to a forward contract in that the company's position is fixed by the rate of exchange in the future contracts. But because futures are traded on the exchanges market, so it is legally binding. It binds both the parties in the contract. There is no such thing in case of forwards. They are all over the counter. There is no third party involved here in case of a default happens to intervene and then settle the account. See, if they enter into contracts over the counter, that is without any kind of intervention from any other third party, they themselves decide. A enters into a contract with B, so some kind of an agreement arrangement is made between 2 parties. In that case, if one of them defaults, there is no there is no help which he can get from any legal entity, because they have not involved any market or any regulatory authority or any kind of a body to help them with in case of a default. So here we see that for in case of forward contracts, the default is quite high, breach of trust is quite high. Okay, they are fulfilled based on trust, mutual trust, that's it. But in case of futures, it is not so. It is a binding contract, different to a forward contract in that futures can be traded on the futures exchange. So they can be bought and sold. So they are traded on the exchange market. Settlement takes place in 3 months, 3 monthly cycles. Futures are standardized contracts for standardized amounts. So So they rarely cover the exact foreign currency exposure. So they are all standardized, so they can decide on at what rate the contract will be fulfilled, etc. All that would be pre-decided. See, it is legally binding. It's a binding contract. Then settlements are made in 3 monthly cycles. Then we see that they are traded on exchange markets, etc. So those are the features of more secure, futures are more secure. So that security part of it is seen in futures, not in forward. The third derivative is called as option. Whoever is the writer of the option, so when an agreement is prepared, the one who writes the option, then it is see he is given an option. He has an option to fulfill the agreement, fulfill the contract, but he is under no obligation to complete that. He has the option either to complete that, either to fulfill the contract, or he can also refuse to do that, and there is no obligation under which he is to fulfill the contract. So that's why the term itself is called as an option. Option given to the writer of the option. Okay, similar to a forward contract with one key difference. Option gives the right but not the obligation to buy or sell. See, whoever is the writer could be taking the position of a seller, or he could be taking the position of a buyer also. So when he is buying or selling, when he takes the role of a buyer or seller, in either case, because he's the writer, he has the option not to uh, either to exercise it or not to exercise it. But there is no kind of a compulsion which is levied on the writer of the option. So right, but not the obligation to buy or sell currency at some point in the future at a predetermined rate. Now the downside risk, this could be, I said this could be both downwards or upwards. If there is a positive variation, it is upward risk. See, just that there is variation in the planned value, we call it as risk. So risk is defined as any kind of a variation in the expected value is called as risk. So variation could be positive, then we call it as upward risk. Variation affects when it is downward, when it is negatively affecting. So it could also be negative, that is, it is downside risk. The downside risk is eliminated, but there is still an upside potential from letting the option lapse. So there is, I mean, if it is going down, so that can be eliminated. That can be eliminated because of entering into a option contract. But see, there is also, see, they have decided the limit to be here. If it is falling down, they can eliminate. So then there is a possibility of they will not be benefited if it is going up, because they've decided the rate to be a fixed rate at this level. So if it is going down, that can be controlled. Even if it is going down, if it is downside risk also, they do not get affected. But on the other note, they cannot get the benefit if it is going upward. If it is going upward, the benefits are quite attractive, but they are restricting them from receiving those benefits because they have decided the rate to be as fixed. Okay, so but there is still an upside potential from letting the option lapse. So therefore, if it is going upwards, to get benefit out of that, they may lapse the option, not fulfill the option, so refuse to complete the contract. In that case, see, they are not under any kind of an obligation now. Because of the rise in the prices, they can get benefited. Okay, so upside risk, if it is present there, in that case, they can lapse the contract. See, as against that, they will be paying a premium to the other party. Okay, whoever has accepted the contract, now to that entity, that person, some amount of option premium would be paid. By paying an option premium, then they can lapse the contract, not complete, not fulfill that, and they can still get benefit because of the upside risk. At this stage, I think only conceptual knowledge is needed for it. So next topic, let's see. What is exchange rate systems? We see a flexible exchange rate system. Okay. First, let's see a flexible exchange rate system. Under flexible, the term is also called as floating exchange rate system. There is no target exchange rate, and the government allows the exchange rate to be determined by supply and demand in the forex. So the rule applies to the stock markets, exchange markets, everywhere. See, this is an exception to the law of demand. Now, when we understand the law of demand says that when because of an increase in the price, the demand for the goods fall, and vice versa. Now, this is an exception to law of demand. If the demand rises, the price also rises. If the demand falls, the price also falls. So that's the exception based on which we see the stock markets, exchange rate markets, they all function. So the rate is determined by supply and demand. What is available? What is the supply? And if the supply would definitely be predefined or restricted, or only a limited amount of currency which can be traded is available. But if the demand is rising, then as the demand rises, we see that the price, more people want to own these foreign currencies. So when the demand rises, the price also rises. Okay, so here the government allows the exchange rate to be determined by supply and demand in the foreign exchange, forex, foreign exchange market. The advantages of a flexible exchange rate system include automatic adjustment of balance of payments disequilibria. Okay, a freedom for governments to adopt any domestic policies they wish. No need for large reserves of foreign exchange. So automatically, see, whenever there are fluctuations, the foreign currencies which are maintained as part of balance of payment on account of imports and exports. So the dealing with the foreign currencies and whatever is the balance that is maintained, that gets adjusted automatically. It gets adjusted. The government can adopt any domestic policy they wish, because they are not intervening in this fluctuation of the foreign exchange rate. Then they don't have to maintain large reserves of foreign exchange. That's another advantage of having a flexible exchange rate. We'll see the next one. Next system, exchange rate system, called as dirty floating exchange rate system. Dirty floating exchange rate system. This is where governments intervene in the foreign exchange markets. The first one, there is no involvement of the government, but here we see that there is government intervenes in the foreign exchange markets in order to maintain or achieve an exchange rate target. The advantages of dirty floating exchange rate system include ability to a country's exports more competitive by depreciating the home currency. The government is playing a role here in deciding what is the what would be the exchange rate. So in that case, then it is called as dirty floating rate. So the economy can be benefited because of depreciating the home currency. When the home currency is depreciated, when they export, so the export part of it, they the foreign reserves or foreign currencies which they receive, since the home currency is already depreciated, more of the foreign currency will have to be paid to settle the transaction. So it would be benefited by depreciating the home currency. We see ability to assist in controlling inflation by making imports appear cheaper. So that is one way. See, in the whole aspect of controlling the foreign exchange rate, we see the role of government. When the role of government is seen, we call that to be as dirty floating exchange rate. Under a floating exchange rate system, increased demand or decreased supply of currency strengthens its exchange rate. Decreased demand, see what happens if the demand increases, the price rises. Increased demand or decreased supply of currency strengthens its exchange rate. The price of the price, the rate of the foreign currency, no, that rises. That rises, so it strengthens the domestic currency. So the other way around, if there is a decrease in demand, the price also falls. When the price falls, then the currency weakens, and then the consequences can be seen. So this point, let's remember, under a floating exchange rate system, because of the rise in the demand, the price also rises. The price also rises, the currency strengthens. If there is decrease in demand, the price falls and the currency also weakens its exchange rate. Now, impact of different factors on the rate. We see high inflation is one thing. Inflation where the prices are rising. So high inflation weakens the currency due to higher prices reducing exports. So in case of inflation, the prices are rising. Now, when the prices are rising, the currency strengthens. It will have an impact on the export. So thus reducing then we see when the interest rates increase, that will have an impact on the productivity. Short term strengthens currency due to increased demand for currency deposits. Increase in interest rate in the short term strengthens currency due to increased demand for currency deposits. How does it work out? Otherwise, when we were looking at inflation, what happens? By rising the interest rates, the productivity decreases. But here it is completely about the exchange rate. See, when interest rates increase, people stop producing or stop taking up productive activities. They look at alternative avenues. So one of the alternative avenue here is to trade in foreign exchanges. So they move, they divert their resources to be invested into foreign exchange. So when they think about considering foreign exchange transactions, trading, in that case, the demand rises. When the demand rises, the price rises. Therefore, the currency strengthens. That is increase in interest rate. So that is what actually happens. So productivity gets affected. The productivity reduces. So people, as an alternative avenue, look at the securities market, foreign exchange rate market. They look at precious metals, gold, silver, etc. So to be invested there so that they can earn a benefit. When the demand for these foreign currencies increase, the price also increases. These are exceptions. So the price also increases. Then when the price increases, price of the currency increases, so the currency automatically gets strengthened. The other way around, when there is an increase in interest rate, in the long run, what happens? It weakens the currency through lack of competitiveness of local businesses. So longer term, it weakens the currency. How does it happen? Through a lack of competitiveness of local businesses. So in that case, if the scenario prevails for a longer period of time, people look at other alternatives. So in the short run, immediately there could be seen there could be an impact seen in the short term where the currency strengthens, but it doesn't happen in the long run. Why does it not happen? Lack of competitiveness of local businesses. So then they can uh, divert to the local businesses. So the activity can shift from the exchange rate market to their local businesses. In that case, then again we see that because of that, the currency again weakens because the demand falls and the price falls and the currency weakens in the long run. If at all, if there is a trade deficit, the trade deficit because of mismatch between the imports and exports. In that case, if there is a trade deficit, it weakens the currency due to supply of sterling for imports, which are greater than imports are greater than the demand for sterling for exports. So in that case, the currency weakens. So imports, what is imported as against that the sterling, the currency is paid, and then when they export, they receive the foreign currency. So then imports, what they are paying is more than what they are receiving. When the imports exceed the demand, then in that case there is a deficit, and that deficit weakens the local currency. Speculation can strengthen or weaken a currency. So people do get involved in speculative activities, speculate what would be the price for the future, and take up the activities. Then we see single currency zones. So single currency zones. See, each country has a different currency, but a group of countries, when they adopt a single currency, we call that to be a single currency market. 19 members of the EU have adopted a single currency, the euro. What is EU? The term EU is about European Union. Okay, multiple countries in Europe have considered this single currency. The currency is named as euro. So for them, all of them have the same currency. 19 members of the European Union have adopted a single currency, the euro. What are the advantages? The advantages of this are removes transaction costs of buying and selling currency. Everywhere it is the same thing. If the currency has to be bought or sold, see, there are certain additional charges. You must be aware of that. So you must be knowing that when the transaction is taken up, see, when we are buying foreign currency or selling foreign currency, there are certain transaction costs which have to be incurred, because everywhere it is the same currency in all the 19 countries. If it is the same currency, in that situation, there would be no additional transaction cost which would be needed to be incurred. Okay, removes transaction cost of buying and selling currency, removes exchange rate uncertainty, and encourages international trade. So the point about fluctuation in exchange rate uncertainty can be removed, and it encourages international trade. So all these 19 countries, they can trade with each other without any issue of exchange rate. Next one is increases competition through price transparency, makes foreign direct investment easier because all of them are following the same currency, euro. So anything can be taken up. So any kind of a New investment, foreign direct investment can be taken up. Increases competition through price transparency, etc. We will also look into what are the disadvantages. The advantages are listed out here, and then now we see that there are disadvantages. So disadvantages of this are there is only one monetary policy for all countries, whatever their economic circumstances. So uniformly, it would be because they are all dealing with the same currency, euro, across the European Union. So one monetary policy only would be followed, irrespective of what is their economic position or circumstance. Second one, countries cannot change their exchange rate if they lose international competitiveness. Limits have to be put on countries' fiscal policies as this has implications for monetary policy. So it is not possible to make any changes, irrespective of whatever is the situation prevailing in the economy, since it is decided to follow a single rate, single currency in the single market. Then even if it is not their situational circumstance to follow that, they are still under a compulsion to follow the single currency. They cannot make any changes. They cannot be benefited because of international competitiveness. Limits have to be put on countries' fiscal policies because it is involving the flow of money. Okay. Um, so that is about the international aspect of doing the business. Um, the international aspects of what are the international markets, exchange rate regimes, single currency zones, and we've also learned about what are the foreign exchange risks. Okay. So let's answer few MCQs related to this topic. If you can wind it up today, then tomorrow onwards. So maybe it may not extend till 20th, but as many days as possible. If whatever we require, we'll continue and then we can wind up the session. We'll go to the MCQs file. Let's answer the questions. Which one of the following is a characteristic of floating or flexible exchange rates? They provide automatic correction for balance of payment deficits and surpluses. Then they reduce uncertainty for businesses. Transaction costs involved in for exchanging currencies are eliminated. They limit the ability of government to adopt expansionary policies. We are not studying this in general. In a generic sense, they reduce uncertainty for businesses. That is not what is the concept of floating rate. Floating rate, they get fluctuated. They see that is not corrected by the government by intervening into the system. They allow it. So when the foreign exchange rate is allowed to be fluctuating, then in that case we see that the balance of payment deficits and surpluses automatically they get corrected. So that is the attribute. See, reducing uncertainty is not an attribute at all. See, transaction costs involved in exchanging currencies are eliminated. This is in a single currency zone, not here as part of flexible exchange rate. They limit the ability of government to adopt expansionary policies. Here, the government is not intervening into the prices, but it is not limiting the ability. So there is no obligation on the side of the government to not intervene. Okay. The main advantage of a system of flexible or floating exchange rate is that it provides certainty for those engaged in international trade, provides automatic correction of balance of payments, reduces international transaction costs, it says that provides certainty for those engaged in international trade, provides automatic correction of balance of payments, reduces international transaction costs, and provides discipline for government economic management. What's the answer? Like in the previous question, it's the same answer. Automatic correction is possible. Automatic correction in balance of payments.
Yeah.
122, the advantage of dirty floating exchange rate includes making a country's exports more competitive, assisting in the control of inflation. Which of these following are true? Dirty is where the government intervenes into deciding what would be the exchange rate. So, what are the advantages of dirty floating exchange rate? Making a country's exports more competitive. It is not a policy about encouraging the exports, but the impact can be seen. The dirty floating exchange rate ability to make a country's exports more competitive by depreciating the home currency. Then also it assists in controlling inflation. This seems to be correct. We see both of them are correct. See, it is making countries' exports more competitive. See, that is correct. And assisting in the control of inflation is also correct. Both of them are correct.
Both of them.
What the option is, both the statements are correct. Okay, good. 123. A devaluation for the exchange rate for a country's currency will normally result in which two of the following? We have to select two. Devaluation of the exchange rate of a country's currency will normally result in which two of the following? A reduction in the cost of current account deficit, an improvement in the country's terms of trade, a reduction in the domestic cost of living, an increased level of domestic economic activity.
Increased level of domestic supply will be there.
The advantages of a flexible exchange rate system include automatic adjustment of balance of payment, then freedom for government to adopt any domestic policy they wish, and no need for large reserves of foreign exchange. An improvement in countries' terms of trade cannot be the answer because at what price or the goods will be sold, what's the credit period, those things are about terms of trade. Here there is a devaluation of the exchange rate, so the currency has weakened. A reduction in the domestic cost of living also is not appropriate. So we'll discuss about A and D. A says a reduction in the current account deficit. So at the time of exporting, because with a weakened or devalued domestic currency, they will receive more of domestic currency because the currency has devalued. The exports they will have to receive more on the exports. There will be surplus there. Okay, a reduction in the current account deficit. Fourth, so that can be taken as fourth one, an increased level of domestic economic activity because the foreign reserves are good. Um, the See, in the long run, we can see that there will be an increase in the domestic economic activity. So, when the currency is devalued, it is weakened. So, the investment would be moving towards productive activity. So, there would be more of a domestic economic activity. So, on that note, we go with A and D. What is the impact of a fall in the value of country's currency? Exports will be given a stimulus. The rate of domestic inflation will rise. Domestic inflation. First one, exports will be given a stimulus. So just now we've discussed that there will be an increase in the, benefit in the exports. So that would be given a stimulus. It will boost exports because more will be the local currency which will be received against the exports. The rate of domestic inflation will rise. So the productive activity increases. More of activity, more of income. So when more of incomes, the domestic inflation also rises. So in that case, C would be the appropriate answer. Which of the following is not a benefit of a single currency? Single currency system. See, it is a disadvantage we're talking about, not a benefit of a single currency. Single currency has certain advantages. In terms of advantages, removes transaction cost, removes exchange rate uncertainty, increase competition through price transparency, making foreign direct investment. Disadvantages are there is only one monetary policy for all countries, whatever their economic circumstance. Countries cannot change their exchange rate, so they would lose to the international competitiveness. Limits have to be put on countries' fiscal policies, as this has implication for monetary policy. So, which one can be taken to be as a disadvantage, not a benefit of reduced transaction cost is a benefit. Then we see lower interest rates, reduced exchange rate uncertainty, increased price transparency. The increased price transparency, reduced exchange rates uncertainty, these two are also advantages. Lower interest rates, that is not a advantage, not a benefit. The major disadvantage of a currency, single currency to an individual country is a loss of monetary control, loss of physical control, higher transaction costs, none of the above. See, is it monetary control? There is only one monetary policy, so therefore they cannot make any changes. So there is loss of monetary policy, monetary control, because only one monetary policy, irrespective of what is the country, whatever is the circumstance situation also, they still have only one monetary policy. So they cannot have a hold on the monetary policy. So loss of monetary control. no monetary control. Fiscal control is about what the government earns and how it spends, etc. That's not the scenario here. Higher transaction cost, in fact, actually it is reduced transaction cost. And none of the above. Since we chose A, we cannot say none of the above. Which one of the following would likely lead to a fall in the value of sterling against the dollar? The question is about fall in the value of sterling against the dollar. See, we are talking about the euro market, European Union. So, in the European Union, sterling. Now, if sterling is used, the fall in the value of sterling as against dollar. So, when does that happen? If there is a rise in UK interest rates, okay, if there is a rise in UK interest rates, the demand increases because interest rates, when they increase, productivity activity reduces, the investment will be diverted towards the exchange, foreign exchange. So the demand for foreign exchange increases. Then we see that the prices also increase. But the question is about fall in the value of sterling. So when there is a rise in US interest rates, okay, so US interest rates, then the demand for US dollars increases. So then that will have a negative impact on the, because it is sterling versus the US dollar. So US dollar strengthens because of the increase in the demand for US dollars. So when the price of US dollar increases, it will weakens the sterling. Okay, so we can go with B. The Bank of England buying sterling for dollars. Capital investment flows from New York to London. Here, the fall in the value of sterling. See, if the Bank of England is buying sterling, in that case, the demand for sterling increases. The price also should increase. See, the price should increase, but it is not so. We are discussing about fall in the value of sterling. D says capital investment flows from New York to London. So New York, from there, if it is coming to London, if there is an investment to be made, in that case, the demand for sterling increase. When the demand increases, price increases. So on that note also, we cannot choose D. So the most appropriate one is D. The current rate of exchange between UK and United States is £1 is equal to $1.5. The sterling price of a Jaguar car is £100,000. If the exchange rate moves to £1 to 1.40 and the sterling price remains the same, what will the new dollar price of the car be? We have certain information. Initially, we see that so when the car is worth 100,000, what was in So from the information, we can understand that the price of the car in dollars can be taken to be as 150,000. Now the price has fallen. So 1 pound is 1.40. The price of the Jaguar car has not affected. So if it is 100,000 for the Jaguar car, in terms of dollar price, it will be what? So I will write it here. See, when it has fallen down to $1, 1 pound is equal to 1.4 US dollars. So the price of the car is the same, 100 pounds. To take 100 pounds is equal to what in terms of US dollars? So the answer should be 140,000. 100 into 1.4 is 140. Which of the following is unlikely to affect the demand for sterling? See, an increase in UK exports, an increase in UK imports, government intervention to unlikely to affect. Government intervention to support the exchange rate, overseas investors making investments in the UK. See, when they export, an increase in the UK exports. Demand for sterling export, so they would be receiving. Okay. So when they import, they will have to pay in sterling. So they would be using that. Here in the scenario, we cannot talk about the increase in the demand. But if it is in export, when they are an increase in exports, they would be receiving receiving in their for the exports. If the sterling is strengthened, it would be benefited. It it is unlikely to affect. So unlikely to affect scenario will be when they import. Okay, logically when we think about it, see, if at all, if there is government's intervention, the demand gets affected. Government intervention to support the exchange rate, it changes, it fluctuates. Overseas investors making investment in UK also will increase the demand. When does the demand not get affected? Is only in a scenario where UK has more amount of imports. So when they import, they will have to pay in the sterling. So when they are actually paying, there is no demand which is arising in terms of making payment. It is just the present scenario which would be prevailing. Okay, on that note, B will be the answer. A company orders a new machine from a foreign supplier. A company orders a new machine from a foreign supplier with payment in the foreign currency. Unfortunately, the domestic currency weakens during the credit period, resulting in the machine costing more than originally expected. This is an example of which type of foreign exchange risk. See, we have three types of foreign exchange risk. One is economic risk, one is transaction risk, one is translation risk. Default risk is not in terms of foreign exchange, but in case of business risk, because they have a policy of selling goods on credit basis. The customer, when he fails to pay, then that is a default. Default risk is part of a business risk, but we are only talking about foreign exchange risk. There are three types of foreign exchange risk: economic, transaction, translation. Okay. Here, because of the time period, the day when there is an order and the day when the settlement is made. Here, a new machine from a foreign supplier order was placed. Okay, then unfortunately, the domestic currency weakens during the credit period, resulting in the machine costing more than originally expected. This is an example of which type of foreign exchange risk. Please answer.
Yeah, ma'am.
What's the answer?
The
It is transaction. Because
transaction risk, yeah.
it's transaction. Translation and investments are made in foreign country, and when they have to be reported, at that time when they are translated into the domestic currency, any kind of risk arising is translation. Because of long-standing fluctuations in the foreign currency, if that can have an impact on the economic activities, then it is called as economic risk. 131 says that there is a risk that the value of our foreign currency denominated assets and liabilities will change when we prepare our accounts.
Mm.
To which
Translation risk.
translation, because they have to be translated, because it is part of the financial statements, how they prepare the accounts, how when they translate, when they convert them, those assets into the domestic currency. So it is translation risk. So it is only a book loss risk that is appearing in the books of accounts. The risk actually arises only when they sell that and realize lesser value. 132. All of the following can lead to a rise in the exchange rate appreciation for a country except one. Which one is the exception? Is it high inflation, an increase in interest rates, a trade surplus, or a speculation? All of them can lead to a rise in the exchange rate. So appreciation can happen except in one situation.
In high inflation.
When there is when there is an increase in interest rates, the demand increases, the price also rise. Demand for foreign currencies, foreign exchange rate, so if that increases, then in that interest, then the exchange rate also appreciates. We don't want the option here. Which one? One is an exception. So we are looking at high inflation rate. There is no such thing about the rise in the price of the exchange rate. Okay, if it when does a trade supply happen? A trade supply happens when the exports exceed the imports. Okay, so here in terms of imports, they will have to pay more, and exports they will receive more. So when they are receiving on the receiving end, then we see that there is a surplus. Okay, at that time the price, if it rises, it is beneficial for them. So the trade surplus is an indication that there is a demand or rise in the price of the currency. Then speculation also it can result, but not so with the inflation. Question number 133. Few are there, we can wind up this particular topic. In comparison to forward contracts, which of the following are true in relation to futures? They are more expensive, they are only available in small amount of currencies, they are less flexible, they are probably an imprecise match for the underlying contract. which of the following are true? True in relation to futures contract. So we are talking about which one is true for futures contract. See, because there is they are traded on the exchange rate, there would also be transaction costs involved. See, forwards are over the counter. So mutually between two entities, there can be an agreement and they can enter into a contract and fulfill that. But in case of futures contract, they are traded on the exchange market. So there would be certain transaction costs also included. So they tend to be more expensive. They are only available in small amount of currencies, very and they are settled in 3 monthly periods. Okay, that's right. They are settled in 3 monthly periods, so they are less flexible. It is not possible for one party to back out of the contract and then default on that. See, no adjustments can be entertained because they are guided by or they are binded by the contract. So there is some intervening party to involve in that in situations of not fulfilling the contract. So they are less flexible. They are probably imprecise match for the underlying contract. They are probably an imprecise match. See, maybe the price that is decided may not be the appropriate, an imprecise match for the underlying contract. So we can also take this to be as the option. So all of the above are goes with the EDPLC is a UK company that imports furniture from a Canadian supplier and sells it throughout Europe. EDPLC has just received a shipment of furniture invoiced in Canadian dollars for which payment is to be made in 2 months' time. Neither EDPLC nor the Canadian supplier use hedging techniques to cover their exchange risk. If the pound sterling were to weaken, first situation, the pound sterling were to weaken substantially against the Canadian dollar, what would be the foreign exchange gain or loss effect upon EDPLC and the Canadian supplier? Indicate your answer by clicking in the appropriate box. So take time to think about it and then give the answer. The pound sterling has weakened. The pound sterling has weakened. It indicates that they have imported. They will have to pay in the sterling. So since the sterling has weakened, now when they have to pay to the Canadian supplier in dollars, see, because the sterling has already weakened, they will end up paying more amount as against the dollars.
So it will be a loss.
Let's just look at the scenario where it weakens and it strengthens. See, when the US exchange rate from 108, it has fallen to 105. We call that to be as when an exchange rate changes, one of the currency will appreciate, the other one will depreciate. See, here in this case, the yen has strengthened and yen has appreciated and the US has depreciated. But the situation what we are discussing here in the case study is the scenario has weakened. When the scenario has weakened, they will end up spending more amount of currency will be used. Here it is appreciated, so less amount of currency. There it is weakened, so more amount of local currency will be used. So when they have to spend more amount of local currency, it would be a loss for EDPLC. So from EDPLC's point of view, it would be a loss because the currency has weakened. Okay. From Canadian supplier's point of view, Canadian supplier will be receiving his own dollars, but unless and until he has to pay, it will have an impact on that. Okay. Now he is receiving, see, he would be receiving his value in terms of his dollars. Okay. Then he will not, as of now, he will not get affected because he's only on the receiving end. He's not making any payment. How much currency will he pay, less, more? That is not a scenario what we are looking at. So there would be no effect for Canadian supplier. Edited PLC has a pay a Spanish supplier 100,000 euros in 3 months' time. The company's finance director wishes to avoid exchange rate exposure and is looking at 4 alternatives. Do nothing for 3 months and then buy euros at a spot rate. Pay in full now, buying euros at today's spot rate. Buy euros now, put them on deposit for 3 months and pay the debt with these euros plus accumulated interest. Arrange a forward exchange contract to buy the euros in 3 months' time. Which of these alternatives would provide cover against the exchange rate exposure that EdTed would otherwise suffer? To do nothing is it is meaningless. Do nothing for 3 months and then buy euros at the spot rate. What would be the rate or after 3 months? Nobody knows. So there still would be a exposure to risk. They want, the finance director wishes to avoid exchange rate exposure. So do nothing and on that day take up an action. So we do not know what would be the change or fluctuation in the rate after 3 months. So that still will put the company at risk. So one cannot be chosen. Second one, pay in full, buy euros at today's spot rate. So they have to pay a Spanish supplier 100,000 euros in 3 months' time. Okay. The companies can pay in full, buying euros today at today's spot rate. Can we go with this one? Pay in full, buying euros at today's spot rate. We'll see the other ones. I'm not sure. Buy euros now, put them on deposit for 3 months and pay the debt with these euros plus accumulated interest. So now the payment has to be made in euros in 3 months. So today only they buy and put it on some deposit, earn some additional interest and use all of that to make the payment. So at least he would have the interest with him. Pay by buying euros anyway, the payment has to be made in euros. So at the end of 3 months, the euros only have to be used to be paid. But during this 3 months, at least he will earn some accumulated interest. So that is 3. 4, arrange a forward exchange contract to buy the euros in 3 months' time. So for an exchange, forward exchange rate contract can be entered into, so that will be mitigating the any kind of risk. 3 and 4 only, or 2. Buy in full now, buying euros at today's spot rate. See, third one talks about buying buying the euros now and earning additional interest. At least here, because they have to make the payment in the euros. So today they would be buying to be settled at the end. If they wait until 3 months, what is the fluctuation they would not know. So it can be taken as taking up purchasing that at today's rate, and if it is anticipated that it would rise in the future, so they can protect themselves against the rise in the prices of euros. So that is another alternative. So we go with 2, 3, and 4. Buying full, but third option says that additional interest is earned. So that is a benefit. But here maybe the anticipation is that the prices of these euros may rise in future. To safeguard against such a rise in prices, we are buying it now. Okay, so we are done with the international aspect. So if we look at the chapter wise coverage, so the chapter wise coverage, we finished with the first chapter, and from 1 till we have come to 6. 6 chapters are done. So we have another 5 chapters, but these are easier. We see investment appraisal is one thing, discounting and investment appraisal. Then we have summarizing and analyzing data, index numbers. Then we have interrelationships between variables and forecasting. So this is something which we are, I hope you have done statistics and the other topics in your graduation program. So I don't think there would be difficulty for you to pick up on these topics. Quickly, let's run through what is there as financial context of business 3. We have discounting and investment appraisal. So discounting and investment appraisal. The first thing we would be learning about time value of money, the logic behind that simple and compound interest. How do we calculate equal rates of interest? Then terminal value, if it is terminal value, sinking fund, etc. NP, the techniques which we use, NPV, IRR, etc. have to be learned. So let's just quickly go through that. See, the time value of money. As the time passes by, the value of money decreases. All of us know that. So we keep listening to people at homes also, that the elderly people is at home. They keep talking about that in our days with 100 rupees, or even really even very elderly people also, they talk about with 1 rupee we used to do so many things, grandparents and their parents and all, to get a chance to talk to them. So 1 rupee or 100 rupees were worth far more than what it is worth as on today. What actually happened? See, there is one principle in economics which says that that is discounting principle, which says as the time passes by, the value of money decreases. So money received today is worth. So if we are here as on today, whatever is the currency, this would be, as the time passes by, the value of this currency keeps decreasing as the time passes by. So to receive anything today is far more worthy than receiving it at a future date. Okay, that's the principle. That's the discounting principle of economics. Money received today is worth more than the same amount received in the future. It has a time value. So because of that, see, whatever are the cash flows that are expected to be received in the future, now they have to be discounted. So let's say if there is a proposal to invest something today, as against the cash flows received to be received in future. So every future value that is received has a lesser value. The discounting principle says that it will reduce as the time passes by. Because the time passes by, the value of money reduces. So we see if there is a promise to receive the money, if it has a face value of cash flow, that face value of cash flow should be discounted to make it at its real value. Okay, discounted cash flow technique takes account of this time value of money when appraising the investment. So why money has a time value? Why money has a time value? Because of cost of finance. Let's figure it out. Let's say that if Mr. X has 100 rupees, so X can approach the bank to deposit that. So if the interest rate prevailing in the bank is 5%, at the rate of 5%, if he invests in the bank, and this 100, this is 0 year, at the end of 1 year, this 100 becomes 100 plus he will earn interest of 5. So 100 plus 5, it becomes 105. So if a person has 100 as on today, it will be equal to 105 after 1 year, or having 105 after 1 year is as equal to having 100 today. So the value reduces because the quantity is increasing. So 105 after 1 year is worth equal to having 100 as on today. Therefore, 105 has to be discounted to 100 if we are to find out the value as on today. So one reason is cost of finance. Second is the investment opportunities when they invest, when uh, see, the amount of invested which is in 0 year, as against that the return is not received as on today itself. The return is received from the future spread over a period of time. So it goes on till the nth period. See, as the time passes by, the risk also increases. See, the returns, and only when the returns, all of them are taken into consideration, compared with the investment are made as on today, then it has to be assessed for its profitability. Because of the investment opportunity, here we see that the value of money is differing. See, the risk aspect is gets included. The longer the time period, greater is the risk. Because of that, we see that the value of the money which is received after a very long period will have a definitely a lesser value, because they have to wait until that time period to receive the cash flow, and the risk increases on account of that. Okay, so because of investment opportunities, because the prices keep rising, because of inflation, as they move into the future, more amount has to be spent as against that. So because of inflation also, we see that the value of money reduces, because the risk that is involved in any type of transaction that has to be taken up. So these are the reasons why money has a time value. So now what has to be done? If there is a reduced value or a discounted value, when we have the cash flows mentioned at their face value, these cash flows mentioned at the face value have to be discounted to make it at a value as on today. So today's value, to bring it at today's value, what has to be done? So the cash flows have to be discounted at a discount rate. Now, what is that rate? So what is that rate? The usually the discount rate that is used to discount the cash flows is taken as, it says that time value of money expressed as an interest rate. The prevailing interest rate in most of the times it is taken. If there is no other additional information, interest rate is taken as the discount rate. At that rate, the cash flows are discounted. Or sometimes this information is not available. See, all the types of capital that are invested, the cost of capital which is paid on all the types of capital, the weighted average cost of capital, WACC, is calculated, and WACC will be the rate at which the cash flows will be discounted. So WACC, or it says that and or a required return. See, the minimum return what the investors expect, okay, from the investments, we can term it to be as R. The cost that is paid um, on the cost of capital is denoted as K. See, at least to pay the cost of capital, there should be a minimum return which has to be earned. So when R is equal to K, it indicates that the rate of return that is earned is sufficient enough to make the payment of cost of capital. So in situations where the minimum required return, the required return is as much equal to as the cost of capital. So any of the things can be taken as the discount rate, whether it is interest rate or cost of capital or minimum required return, so that the cost of capital can be paid. Usually, now what is profitable is, it is profitable when the rate of return R exceeds K, which means that even after making the cost of capital also, they still have something else remaining, additional profit which is remaining, so that with that they can take up additional investments, etc. So profitable scenario is a scenario where the rate of return earned is greater than the cost of capital. So that is about discount rates. Let's stop on this note. We will take it up tomorrow. How do we calculate what is simple and compound interest, and then time value of money? See, the examination kit also, I'm assuming, see, many numerical questions are there. So in the examination kit also, as we keep solving these questions, we would get a better hold on how to do that. So let's continue from tomorrow. Okay.